What's up everyone, it's Kadi with MoneyVest. So in today's video, we are going to be talking about one stock that I do believe has a lot of potential long term. They're still struggling to actually become profitable right now, but this is a company that is still down significantly from its all-time highs. It's down over 60%. It's in the cybersecurity sector and only worth under $18 billion, although it has recovered quite a bit from its lows, up over 150%. We've talked about this company before. It recently had a huge breakout after reporting earnings for the fourth quarter fiscal year 24. We're going to talk about this company in full detail and talk a little bit about the intrinsic value, the fundamental analysis, the technical analysis. All of that is going to be discussed in this video. As always, if you enjoy it, find it helpful, all I'm asking in return is that you drop a like and of course subscribe to the channel if you haven't already. And the link to our Discord and Patreon is going to be down below if you're interested in joining us, and of course getting access to all the members only private videos, including all the trade alerts and trade ideas and options alerts, and everything is going to be included, as well as the moneyvest.com platform that's also going to be available here fairly soon. And also do connect with me on Instagram. My handle is going to be CASWRP. You can access all of our stories from there, portfolio updates, polls and tips and strategies over there also. So the company that we are talking about today is going to be none other than Okta, and Okta is in the cybersecurity sector. So if you come over to take a look at what Okta basically provides, again, it is in the cybersecurity sector. Fiscal year 25 priorities are going to be security, reignite growth, and of course scale Okta from a sort of total addressable market standpoint. They do have a market opportunity of just over $80 billion. And this right here is where they focus on, right? Identity is the critical foundation for connection and trust between users and technologies. Cloud security and digital transformation is what they basically offer. So if you come take a look, provision of an identity management platform for enterprises, operates through the United States, international geographic segments. The firm's products include sign-on, multi-factor authentications, API access management, authentication, user management, and lifecycle management. So every time we have to authenticate ourselves for multi-factor, Okta is one of the companies that's behind that type of technology as well. So almost 19,000 total customers with over $3.38 billion in remaining performance obligation RPOs and 111% in dollar-based retention rate, 24% compounded annual growth rate for revenues from fiscal year 22 all the way through fiscal year 25 end is what they're expecting, or just under 2.5 to as much as $2.505 billion in revenue for the company. And this right here was the fourth quarter numbers of revenues coming in just over $605 million, up 19% year over year. Subscription revenue is up 20%, just under $600 million. We got RPOs growing at 13% and current RPOs growing at 16%. And then we did have non-GAAP gross margins up 2.7 percentage points to over 81% gross margins and 21% operating margins, with free cash flow margins of over 27%. And of course, total customers, as I mentioned earlier, up 8% year over year, and customers with over $100,000 in average contract value of just under $4,500 here, up 14% for the company as well. And this right here is going to be the consistency in revenues, and subscription revenues also growing very, very nicely. As you can see, up over 98% of the revenues coming from subscriptions. So it is a very sticky business model, a very much of a SaaS company here. And this right here are going to be the remaining performance obligations, so RPOs, up 16% year over year on a current basis, and non-current are going to be sitting at just over 1.9, almost $2 billion, up 13% year over year, and customer accounts also growing to almost 19,000, up about 150 from a quarter over quarter basis. And this right here is going to be the balance sheet with a current ratio over 1.67, quick ratio 1.5, debt to free cash flow a little bit higher at over 4, but the company does have a lot more cash than debt on the balance sheet, with over $2.2 billion of cash, $1.3 billion of debt, with a net debt of negative $905 million, and expected earnings per share increase from $2.26. So that's actually one of the things that is the only thing that's kind of concerning for Okta here, because they are not yet profitable. $2.2, so $2.26 all the way to $17.95, almost $18 per share for the company by 2034, and that's going to be a growth rate of about 25, almost 26% for the business. So if you come back over to the company's fundamentals, you can see the revenue growth has been pretty solid, I would say. It's grown from about $41 million to well over $2.2 billion on a trailing 12-month basis. So very nice, consistent growth here. You can take a look at the gross profit going from 22.3 million, to over 1.6, almost $1.7 billion. And operating income has just been generating an operating loss for the company. So that's basically where the profitability basically ends is after the gross profit. So this is, again, they are profitable on a gross basis, but when it comes to operating basis, they're not profitable, and they're obviously not profitable on a bottom line net income basis either. So we have seen, again, diluted earnings per share basically go from negative $3.67 to negative $2 per share. And diluted shares outstanding has gone from 16 million shares to over 163 million shares. So that's about a 10x growth. But more recently, though, again, you can see the last 4 to 5 years trend here, 148 to 158 to 163 to 163. So that's really where we are. It's been more or less stable, but I would still account for about 2 to 3% share dilution for the company in our analysis as well. But on a non-GAAP basis, the company is expected to turn profitable here starting fiscal 2025. When it comes to margins, 74% gross profit margins on a trailing 12-month basis for, again, fourth quarter 2024. We expected to see over 80%. The company delivered over 81%. Everything else is unfortunately negative because the company, like I said, is not profitable right now. And valuation also can be argued at a little bit more on the expensive side at over 66 times earnings multiple, with a price to sales sitting at a little bit over 7, price to cash flow sitting at just over 34 to 35, and of course we got a PEG ratio on a forward basis of 1.69, so the growth expectations are quite reasonable compared to the earnings multiple that it trades at the moment, because I believe the growth expectations for earnings for this year is going to be over 44% for the company, so 41.4% is the expected earnings growth, and revenue expected at just over $2.5 billion, and this right here is the entire guidance from the company for the entire, actually this is only for the first quarter 2025, and they're expecting a non-GAAP diluted net income per share, earnings per share of 54 to 55 cents per share for the company. If you annualize that number, that's going to be just over $2 per share for the business. And right now, of course, it's trading at just over $110. So 110 divided by $2, we're looking at 55 times forward earnings multiple for the company, which obviously is super expensive. So if you take a look at the diluted shares outstanding, 182 million, and if you do 182 million times 226, we're looking at a net income of $411 million. So if you come over to the 5-year discounted earnings multiple model here, we plug in, let's say, 411 million in net income. We look at a growth rate from year 1 through 5, so next 5 years, even though market's expecting for well over 25% growth rate, let's just plug in 14%, expected P multiple of, let's say, 20 times, which obviously is going to be a lot lower compared to where it's trading at the moment, 12% discount rate, 10% margin of safety because the balance sheet's pretty solid, 2% share dilution, and we're looking at an intrinsic value of $43 per share. And right now, of course, it's trading at well over $109. So that would result in about almost a 60% pullback needed. And this right here was obviously the ideal price point for an entry for Okta, which was sitting at $42 per share. However, I think we can be a little bit more generous here. We can even go as high as 25 times P multiple with a 16% growth rate. And now we're sitting at just under $60 per share for Okta in terms of that intrinsic value. And that's going to still result or potentially need a 44% pullback for us to be considering Okta, and that's going to be kind of in line with this support level here, where it kind of consolidated sideways for months and weeks here. So it was basically trading sideways here before finally breaking out to the upside, and that next resistance and target is going to be at closer to $142, and support level is going to stay put at $91 per share for Okta as well. So those right there are going to be few levels to keep in mind from a technical perspective. It was on a very nice consistent uptrend, so you can see that it was pushing higher very nicely, higher highs and higher lows. So this right here was the overall uptrend here, so very nice higher highs and higher lows. Finally seeing a breakdown in 2021 towards the end of 2021 going into 2022. We saw that entire bear market, and Okta sold off over 80% from its all-time highs of well over $291, sold off over 84% here, and it's since recovered a little bit, consolidated sideways, and then saw a huge breakout back to the upside. Now it's coming up to that resistance once again right here at $109, $110 per share. That's exactly where we got rejected more recently over here. And right now we're kind of trading back up to that level. So we are overbought here, no doubt, on a technical basis. You can see the RSI almost at 73, so is the MACD. So I wouldn't be surprised to see a bit of a pullback, back down to potentially $91 per share. We also have a big gap to maybe fill after the earnings that we have left in the 90s. But of course, if we do end up seeing a breakout here, next target and resistance is going to be closer to $142. But I would not be interested in this stock at those prices. Even at these current prices, not really that interested. We'll be closer to low 60s, mid 60s, possibly sub 60s. The lower the better is where I would be more interested in Okta from a investment standpoint. From a trading standpoint, even at $91, if we, let's say, do end up coming down, filling this gap, $91 could be a good potential swing trading idea back to the upside with a target back up to $112, and that's going to be about a 12 to 15, actually 20 to 25% potential upside target here, with a support level sitting roughly at $91, and then below that $66, $67 per share to watch for Okta as well. Profitability is still a bit of an issue on a gap basis, so that is something to keep in mind as the company turns the corner. I think institutional involvement is only going to increase. There's going to be more coverage, more analysts covering the stock, and there is potential for more upside for Okta over the long term as well, if there is some potential for profitability on a gap basis for this company. So hope you all enjoyed this video. Let me know your thoughts down in the comment section below. This is a company that we have talked about in the past. Definitely do check out my Instagram handle is going to be CasWRP, and join our Patreon and our Discord if you want to access, and of course join our MoneyVest community. Let me know your thoughts down in the comment section below. As always, happy investing, and I'll see you all in the next video.